Hello, welcome to another of our webinars. My name is Tom Burroughes. I'm the Group Editor of Family Wealth Report, Wealth Briefing and Wealth Briefing Asia. We're here to discuss an important topic prompted by a recent report produced in conjunction with FundCount. The report is Accounting and Investment Analysis Research Report 2022. There's a great deal to unpack in this report. To try to help me do that and work out what the significance of some of its important findings are for the industry, are three following individuals who join me today on the panel. They are Katherine Dunlevie, Ashley Whittaker, and Will Trout. And before we get stuck in, I would like all of you to briefly introduce yourselves and tell us what you do and give a bit of flavour about where you're coming from in terms of the perspectives that you can give. So, Katherine, would you like to start?
Absolutely. Thank you, Tom. It's a pleasure to be with you today. I'm Katherine Dunlevie, and I run the family office at Synovus. I'm the president and CEO there. We're a multi-family office in Columbus, Georgia, with about 90 families that we serve, going on our 75th year, and have an assets under management of about 10 billion.
Thank you, Katherine. Ashley.
Great to be here with you today. Thank you for the invitation. My name is Ashley Whittaker. I'm President of Global Sales at FundCount. We are a software provider to the investment industry, and about 40% of our clients are family offices and multi-family offices right across the globe.
Will.
Yes, I'm next, Tom. Thank you. My name is Will Trout. I'm Director of Wealth Management at Javelin Strategy and Research. We are an advisory firm focused on the intersection of strategy and technology in financial services and wealth management specifically. I'm delighted to be here.
Thank you all for joining us. Well, when I went through this report and had a good dive into it, obviously a great many questions come out from it, and I've picked a few out at random. So in the sort of in this following fashion, I'm going to start with the following question, which I'd like to put to all three of you. The first one is this. The report says that over recent years, manual work in family offices to handle data and related areas has actually increased rather than gone down, which might appear counterintuitive. In your experience, I mean, is this true? I mean, if this is the case, that manual labour has actually gone up rather than down, what's causing it? Ashley, what do you think is going on here?
Well, I think there's a number of factors, actually. The first is the increase in scale of family offices. And I think the FT reported that during the pandemic, family office wealth went from 5 trillion to something like 12 or 13 trillion. So there's obviously a scaling up going on. Secondarily, for many years now, and it started with perhaps PE, but it has got into all sorts of other assets like crypto recently, despite its current wobbles, there has been a greater multiplication in the asset classes that family offices are traditionally dealing with. And if you add those two things together with the fact that many family offices are perhaps underinvested in IT, both in terms of staff and software, then you end up with a lot of generalist software, particularly Excel, which is far more prevalent than any of us would like to admit. And I think that inevitably generates a lot more work as you get larger and more complicated. Katherine,
what's your take on this particular point?
I would agree wholeheartedly. I think what Ashley said is spot on. What I've seen is that you still have family offices on legacy systems. There's a cost component to get off of that. There's simply a change management component of the thought of big conversions are tough. And there's been a lot of growth in the industry over the last few years. And I think people are sort of fighting so hard to just keep up with the growth that the thought of slowing down to really look at systems and make changes is tough. I would agree with what Ashley was saying. A big piece of it too is there's a lot more investment in private equity, direct investing. The alternative space is making this tougher because there's no standardization out there for reporting or even getting data. You're still getting emails with PDFs from private equity firms, and then you've got to go manually enter that and in your like he said, probably in Excel spreadsheets. Maybe you can upload it into your systems, but it's I would, like I said, agree wholeheartedly that it's gotten worse, not better.
Will, what's your take?
Yeah, I would agree that the issue of expanded access and interest in alternative or private capital investments is a huge piece of the issue. I think the study you mentioned, Tom, said that roughly 40% of the 40-hour week was spent on manual processes. I think this is going to be particularly extreme in the world of the MFO, which is multifamily office, is quite a broad category, can in the US at least be an RIA, can be a single family office that has started to serve other family entities or expanded its mandate. I think wealth managers of all stripes, and certainly at the high net worth end in the MFO space, are trying to do several things. I mean, clearly improve the client experience, particularly for their next generation clients. They're trying to become more efficient and scale. They're also trying to remain compliant. So balancing sort of this trinity of concerns plus the data challenges that Ashley and Katherine mentioned is no small task. And frankly, these entities continue to lag in terms of both the tools they have on the table and the resources, human and otherwise, they can bring into the mix.
Well, that, I think, leads us in seamless fashion to the next sort of question I've got in front of me here, which is that in one of the findings, which you see quite prominently at the front of the report, more than half, that's 53% in specifically of respondents, of those questions said that they use non-specialist general ledger accounting software alongside 54% using generalist tools for partnership/investment accounting. So what's preventing managers from going to a more specialist offerings? I suspect we may have even sort of hinted at it in previous answer. Reverse fashion, Will, what's holding them back from going down the specialist route, would you say?
Well, I think we did hint at it, Tom, and I think change is hard and also expensive. And particularly given the diversity of investments and priorities and operating companies, there is no silver bullet, Tom. And so getting your arms around the data, whether it's simply as something very tactical like extracting data from a PDF, or more systemic changes shifting to sort of real-time workflow and decision-making abilities is super hard. And so I think there's a kind of, fear before you jump, syndrome taking place here as well.
Yeah, I certainly have picked up on that sort of mentality from a number of other people I've spoken to about why family offices are quite shy about technology. We might want to come back to that later, but it certainly is a problem. Katherine, what's your take?
Yeah, it's trying not to be repetitive, but I think this the integration is tough, and some systems have APIs, some don't, and so you also don't want to have sort of a spaghetti of too many systems to manage. So when you start talking about becoming more and more specialized with certain components, that's what you're fighting. And so where do you specialize? Because it's what do you pick off first? How do you prioritize it? And I mean, Will said there's no silver bullet, and there's definitely not, but how do you get the system that plays the best with all the pieces that you need to pull together? And it's hard to identify. It's a long process. Building out requirements is tough. So I think that's why you see people just continue to do it the way they've done it. It's easier than, it's a big hurdle to jump than to take the plunge.
You can always throw bodies at it. Not a good solution.
Exactly.
But
and they appear less expensive than if you're going to go full bore and you see that price tag and it's like, whoa, maybe I'll just keep hiring folks.
Actually, from your perspective as someone on the FundCount side, depending on who you believe in the press, you never want to do that, by the way. We are heading for some difficult times economically in that kind of cost environment where people are suddenly become factual again to think about margins. What's your view about whether people are, what's holding people back from going down the specialist route? Maybe there's some different points than ones that have been made before from your point of view.
Well, Katherine made an excellent point about cost because, I've sold ERP systems for the likes of Oracle in the past, and there was always a business case there. You could always talk about efficiencies and taking out headcount and replacing that with software costs. That really doesn't happen in family offices. A lot of the family offices we deal with are, very well run ships in terms of the costs that they maintain, and therefore there isn't the excess headcount in the first place. But it is about becoming more efficient, and not because of perhaps the traditional reason of thinking about internal operating efficiencies, but just because of how much more complex the world is becoming in terms of data. And really, that's where we focus when we're talking to our prospective clients. It's not about what the software does. It's much, much more about how you deal with incoming data, where you source that data, the quality of it, and how it's dealt with. We obviously then believe, forgive me for being slightly salesy for a second, we obviously then believe we've got a product that is a unified platform that gets rid of some of those integration issues that Katherine mentioned. But and perhaps because of that, we don't see that being the main challenge for clients. It's the change management. It's getting the data into a new system, whether that's integrated or not. But obviously taking some of those challenges out by looking for a set of unified platforms is a good move from a family office's point of view in terms of limiting the stress of that change.
We've
Tom,
been for
something you.
Sorry, go on.
So I was going to say something you mentioned up front, around the pandemic, and I think also generational issue and generational change is going to force the issue somewhat, I think, for many family offices, particularly that want to deliver best-in-class reporting to second generation and so forth. So I was curious if the other panelists had seen that. I mean, Ashley, you're in the sales role. Are you seeing sort of a demand for kind of mobile access and real-time data or analytics, self-service even from these types of stakeholders?
Well, you've hit the nail on the head. It's changing with the generations. Perhaps the older members of our family offices will be quite content with T+30 reporting on Excel spreadsheets and PDFs. The younger generation pretty much wants it same day, next day, with mobile access. So there is a real diversity out there of demands on software providers in terms of the reporting and the methodologies they use for providing those reports. But certainly the great pressure is to speed up reporting. In a world that's coming back to its normal chaotic state after perhaps 10 and certainly maybe 20 or 30 years of relatively benign economic conditions, certainly speeding up reporting is an absolute necessity for most family offices these days.
I would wonder whether, following on from that latter point, actually, the world is going back to a more normal state of chaos, an encouraging prospect that is. We've obviously been through one particularly very disruptive process, pandemic. Now, at the time, you couldn't move for all these comments about how it was accelerating technology. Did a Google search on the words accelerating technology and pandemic, it would blow the server. What's been the reality, though? Do you think it's accelerated it as much as some people thought was going to happen? Well, I mean, Katherine, what's been your perspective on what the effect to which the pandemic may have speeded any of these processes up, or whether it's been a little bit overhyped?
I think there's certainly places where it's sped it up. I mean, it's document management, I think it was a big one. And it quickly, you had to figure out how to eliminate paper and use electronic signature, DocuSign, whatever those things are. And it was interesting to see how quickly all the red tape went away to get those things out the door, which tells you what does slow down some of the processes to onboard new technology. You also had the change management piece of things. People didn't have a choice. And so I think that was another piece that did help. So I would say it feels like we got the low-hanging fruit with, and also, I mean, this kind of situation where you've got a lot better sort of virtual team meetings and collaborating across the country or the world, those sort of things, I think all got better, but that felt like the low-hanging fruit. And then it's been easy for people to sort of go back to not spending the time and energy they probably need to spend to take it 1, 2, 3, 4 steps further.
Ashley, what's been your perspective at FundCount? I mean, has it really sort of lit a fire under certain processes, or has it been not quite so the sort of big kaboom effect that people said it might have been?
It certainly had an effect. I mean, during 21, and I think we saw our business rise 71% over the previous year, which is a good rate of growth for any company, I think. But yes, I think it certainly highlighted to people the need for systems that could operate in a dispersed manner. And obviously that some organizations came under extreme stress because they had systems that were designed to be office bound and obviously worked because of the human glue that was between them, which clearly came under stress when everybody's stuck at home. But I think it highlighted an issue to family offices that was even more concerning, which is just simply the non-standardized and dispersed nature of the data that they're trying to capture and deal with. And that process in particular became a lot harder. So it doesn't surprise me that Katherine's mentioned things like DocuSign and document management, because they're obvious, first kills, as it were, to getting more automated processes. But the second then becomes actually automating your internal operating systems, because that gives you more time to feed back into collecting data, getting accurate data and data of real value. And that becomes a sort of a virtuous loop if you can step into it. But as Katherine rightly pointed out, often these things are, there's more psychological barriers to these things than there are organizational or technology barriers.
Talk about complicated and sometimes non-standardized data leads us to ideas about the one big trend that's been going on, certainly has been going on in wealth management over the last 20 years, has been the increased popularity of private market investing, sometimes conflated as alternatives, private equity, credit, infrastructure, and so forth. These investments generate return data, which is very different from the sort of material that people are used to. They're just tracking what's going on with the S&P 500. Family offices and other organizations clearly need to have accurate information about how well their investments in these areas are doing. And as we've already heard, younger adults are not interested in having to wait for a month or even longer to get the net asset value updates on what their funds are doing. They want it like yesterday. Whether that's reasonable or not, it's another matter. What essentially do you see as working in the space, and are you seeing any examples of things that are working towards a better clarity in information provision in this particularly important area? Katherine, are you seeing examples of good things going on here and examples of progress?
Yeah, one thing I will mention before I answer the good things going on, this is requiring education for the next generation too. We are not there, and that's part of what is good about private equity too, is you don't have a daily mark to market, right? And so your performance may lag, and and today it will lag. And so I do think there is some generational education that's required there. But what is going well is, I would say there is a focus that this is something that has to be solved. And, you know, FundCount's a great example of that. They recognize that they've built technology that's addressing that. And so I feel like you're getting the critical mass of whether it's family offices or just kind of high-end wealth management firms who are operating in that private equity space, who are saying we have to have this. So, and in a market that has been generally so fragmented, I think that's been part of the problem, is you haven't had the critical mass and the voice. But I think you've got that voice now, so that it's worth it to a FundCount to say, hey, we're going to solve this.
Ashley, you need to take over from this point now.
Well, let's have a real example of this, because this is the sort of thing you can do with technology. And this is one of our family offices in the UK. They have a number of investments in private equity companies. They actually mirror the chart of accounts of that company in FundCount. They then, once a month, are sent the TB of that company. And then they have an automated process within FundCount to run 3 valuations, take the average and shove that back into FundCount. In other words, they're not doing the, oh, let's estimate what we think the valuation of this investment is at our year end and then wait another 9 months for the accounts before we revalue it. They're fully automatically revaluing their entities every single month without anybody having to touch it. That is the art of the possible. Whether that's achievable or not depends on your access to data. So it all comes back to that data issue all the time. But there is a lot that can be done out there with technology if you've got the data to hand.
Mm-hmm.
Will, what's your view on this issue?
Yeah, I think Katherine and Ashley brought up great points about data lag and the need for revaluation to sort of connect the dots or present a timely and consolidated picture of positions. I mean, this is a huge issue for family office, particularly those with positions in like cash intensive businesses like real estate. And it presents huge risk, both from sort of the broader portfolio management standpoint and also in terms of liquidity and other factors if you just can't see where you're sitting in any timely fashion. And of course, this is a multi-layered issue, right? This is not the family office's challenge alone. This goes up to the GP who has a liquid holdings and may or may not report on positions, you know, for 6 months. And so how do you sort of what Ashley was talking about, sort of pulling together these different data sources is a huge challenge.
I suppose just to make a comment from my end, where the education side of this comes through is, of course, is that if people want to chase superior returns, what they hope are superior returns by the illiquidity of the asset class, well, there's no free lunches in capitalism. If you hold an illiquid asset, you can't expect to have the same kind of instant reporting that you would get, say, something that trades on the New York Stock Exchange or the London Stock Exchange. There are reasons why these things perform like they do. And so I suppose framing clients' expectations and teaching advisors how to do that without people getting involved in unpleasant conversations is obviously quite a skill. And that's where also the more EQ side of wealth management comes in. It's not, you need to, all of these clever devices and technologies in the world aren't going to work if people's expectations aren't set right about what they can reasonably expect to get. So I am sure there'll be a lot more to be said about that in the future. Just trying to keep things onto our track here. One of the things, and this again is related to the point about reporting, one of the terms I occasionally hear about people in explaining what they think is good wealth management is the understanding that there is a full balance sheet of a client's life. So yes, we have all the asset gathering, wealth creating, cash producing side of their lives, but you also have all the liabilities, spending, both in terms of varying levels of predictability. How well are we doing, say, let's just pick with family offices as an example, how well are they doing in getting that full balance sheet view and in terms of the tools that they are looking at and have available? Ashley, what's your general sense about how well they're doing?
Well, I think in terms of what the technology can deliver, we're there. Certainly, FundCount can deliver an entire balance sheet view of the world for an individual family member at 24/7. I think with legacy systems, it's a bit more of a challenge. You may have, a piece of software that's great at alternatives, another that's great at the market, and then you've got to try and bring those together in a GL that's probably designed for a trading or manufacturing company rather than an investment company. And it becomes a bit of a tough challenge that involves lots of people in Excel in bringing it all together. So it probably feels like it's worse than it is, and it's very far away. But if you've got a system that can deal with all asset classes, if you've got a system that's fully multi-currency at the asset, account, entity and consolidation levels, then these things, shouldn't really be a challenge, because after all, double entry bookkeeping is double entry bookkeeping. But I'm a Deloitte's qualified chartered accountant, so I would say that, wouldn't I? Yeah, I think actually it's, given the right technology choices, it's actually a world you can be in today and could have been in yesterday.
I would just add to that, if I may, I mean, yeah, I think what Ashley and what Katherine have been speaking to is something of a last mile problem. There is the data out there, there's systems to capture the data and pull it in, but then how do you incorporate it into your end system, whether it's your GL or whether it's some sort of reporting document or much less kind of a mobile interface, is really tough. And I think that and automation of processes, workflow around private equity, for example, the subscription process, remain real sticking points for family offices. And so I'm excited to hear you both, or all three of you, sort of put out solutions as well as highlight challenges.
Katherine.
Yeah, I agree. I think we're there. It's just how you get there. And to what cost, and it might be on the backs of people, it might be using technology, but I think we have the full balance sheet ability. It's maybe not as efficient as we would all like, and I think that's where we need to all, or at least a lot of the family offices I'm talking to, where we need to get better. But I would agree, like Will's saying, it's just that it's that final end point. The other piece you have that's never going to stop is you think you have everything, then you're talking to your client and they tell you about XYZ investment they made because their buddy knocked on their door or they were at lunch. So there's always stuff that you just never know, because the world is moving and it's fast and clients are out there just doing stuff constantly. So you're always chasing that piece of it. But from what I think we can get it. It's just how we get it and how efficient is it.
Going back to manual labor, one thing that occurs to us from looking at this report is that one of the big problems that family offices have got is having to deal with the massive different legal entities. Is there anything that can be done about this, or is this simply just one of those things that the family office, or indeed wealth management industry generally, has to deal with as a fact of life? Does anyone want to take a response to that?
I'll start on that. It's interesting. I mean, we have some clients who have 500 legal entities as, just one family. And I think part of it is just as families grow and generations expand, its complexity increases. But I also think what we're seeing with even some new clients, new wealth, is sometimes we make them too complex. And to what end and why? There are now, all the advisors would have to get on the same page, but you don't always have to create these overly sophisticated wealth transfer strategies that you could accomplish the same you could get to the end goal with a different thing that is more simple. But I think it's almost like the people think that complexity is a good thing on one hand, especially the advisors, but we have clients screaming, can you please simplify this for us? Can you please simplify it? So I think that's part of the challenge, is the advisors pushing complexity and clients wanting simplicity. But there's a balance there, and the bigger the wealth and the further you push it down generations. I mean, we have some clients that are in their 7th generation of passing wealth. That's going to be more and more complex.
Yeah, there's only so many things that you can do when you've got that level. But it's interesting what you said about why some incentives or perverse incentives, depending how you want to put it, might exist for people trying to make the thing more complicated than perhaps it needs to be. Just a quick couple of responses to that, and then we'll move on to the final point. So, Ashley, do you think that our industry is almost unhealthily in love with complexity, or do you think it's simply sometimes just an inevitable feature of the real world that we live in?
Well, obviously families grow over time, hopefully, but I think sadly it's a reflection of the complexity of the world we choose to live in and the tax regimes we choose to vote for and adopt. And there's no getting around that. I think, however, that technology can make a difference in terms of dealing with that. Partnership accounting on a family office side is always a bit of a challenge, especially if all your systems are investment focused, which is of course where families are. They're investment focused. It's about maintaining their wealth, increasing their wealth, protecting their wealth. So little thought goes into those back end processes. But there are tools out there, and FundCount is obviously one of them, but there are others to choose from that can actually handle that partnership accounting with relative ease. And certainly as the more complex you get, then one of those corporate governance drivers towards getting technology in is that complexity and making sure that it doesn't get in the way of your investment and operational imperatives.
Final answer to that one, Will. Do you have any views? Do you think we are more complicated than we need to be, or is it simply just the way things are?
It's a mix, I think, as my fellow panelists were saying. Complex background, lots of generations, lots of needs, but I think a road to simplifying a lot of this complexity is the ability to create linkages and connectivity between these different types of legal entities that you brought up, Tom, and that, to my mind, that's a defining feature of modern software systems, so that designed for the family office. So we'll never get rid of complexity, but we can do much to address it.
I sometimes think that there's a parallel between the idea of having different kinds of software being able to talk to each other and having different legal systems being able to talk to each other, or around things like product codes and things like that, where everyone's looking for this one-size-fits-all arrangement, when in fact perhaps a more mutuality or recognition of standards was where you need to go. Anyway, final question I've got for all of you is this. Imagine, if you will, that you're standing in front of a whiteboard with a pen in your hand, and you are going to design the perfect family office system from scratch. No legacy, no nothing, and a very healthy budget. What are you going to do? Ashley?
I think I'd probably be looking for a maximum of 3 core systems. I'd be looking for an OMS to handle my secondary market ordering. I'd be looking for a deal flow system to handle my alternative asset sourcing, and I'd be looking for something like FundCount as a unified platform to do all the general ledger, all the consolidation, the tax, the accounting, the partnership accounting, the portfolio management reporting, performance reporting, etc. And I would keep those 3 core systems to the absolute minimum. That's where I'd go, I think.
Katherine, you're building this rocket. How are you going to launch it off the pad? What's it going to look like?
That is my dream. So this is unique to us. I would get off of a trust accounting system, because that makes things very difficult. But I would have one core that has the API ability to ingest and send out, so back and forth, read, write. And then with that, you have to cover your performance reporting, workflow piece of it. CRM and workflow also would be tied together and not in a separate system. And then the trade order management piece. So you'd have your investment management, your reporting would be with that together, and then your core system, which would be more GL based than us. We're on a trust accounting, so that makes it difficult.
Well, the floor is yours.
Yeah, I mean, I agree with all that's been said, and certainly the concept of a unified platform that pulls together the portfolio management system with the general ledger is key. I think there are other or ancillary workflows or processes that could be much more efficient. I've seen some very cool use cases in Asia around using the blockchain to determine ownership, property rights, and solve KYC problems in a single swoop. So there's still a lot of friction if we look at sort of the challenges here, particularly in MFO spaces as related to client experience. There's a lot of opportunities to remove a lot of that friction that you have, particularly that affects, again, new second generation, new family members that have, frankly, very little tolerance for this type of friction in their experience.
Well, I think that
so
go on, Ashley.
So I was just going to add one final thing off the back of Will's comment, because it's interesting that this comment about blockchain. Sadly, a lot of banks and custodians and alt managers don't have APIs for the simple fact that they don't want people reaching into their systems to grab data. So that world exists on PDFs and CSV files. There is an opportunity out there to bypass APIs as a sort of intermediate technology that doesn't suit the banks commercially, and perhaps go to something like blockchain, which is much more secure for all parties concerned. But whether the family offices individually or collectively can play a part in making that technology leap and skipping a generation will be an interesting thing to watch over the coming 10 or 20 years.
A few are trying, but it's TBD, I think.
Yes.
Well, thank you, everyone. I mean, I'm conscious of the fact that with all of these kind of conversations, they can go on a lot longer. But nevertheless, it's been great to sort of work through these issues in the way that we have. So to everybody involved, thank you very much indeed for your contributions and for continuing to engage with us. And I'm sure I've got lots more to write in my day job as a result of doing all this. So Katherine, Ashley, Will, thank you very much indeed. And thank you for all of who are watching.